Shares of Birkenstock continuing to fall today, just the latest in a series of recent IPOs that have struggled. That is the focus of today's Tech Check with Deirdre Bosa. Morning, Dee.
So here's what we can say so far. The IPO window of 2023, it was short, wasn't very sweet, and now it's likely closed as we head into the year end. Early performance suggests that they've been a bust. Birkenstock ended its first day off by more than 10% from that IPO price. Instacart is down 40% from its first day pop. Arm more than 20 from its. Even Klaviyo, an enterprise software company that is arguably a better indicator for the IPO market, it's down nearly 20% from its short-lived post-debut peak. And all of this before the lockup period has expired when insiders can sell shares. So what is behind the IPO stumble? Well, the fundamentals, they're iffy, but they're not terrible. All four of those companies went public with actual profits, even as revenue growth is slowing at Instacart, Arm, and Birkenstock. Barron's this morning posits whether bankers got greedy, writing, leaving money on the table is just good manners. Mispricing an IPO, though, to raise as much money as possible, that's a poor long-term strategy to win over investors. So that leaves market conditions, which was very much an open question before these companies kicked off their listings. The IPO market had been shut for some 18 months as the Federal Reserve raised interest rates. And while markets have rebounded this year, they've essentially been carried by the Magnificent Seven group of mega-cap tech stocks, which are in a far different league than everyone else. So while it is still early days for the latest class of IPOs, the street is essentially saying, hey, this still isn't the greatest environment. Why not just buy Meta or the NASDAQ? That could be tricky for the hordes of VC-backed and other tech startups that raised money back in 2021 when conditions were a lot better, but may now be running out. A deal today, though, that I want to flag. Atlassian buying Loom for nearly $1 billion. That could be an indication that the M&A market remains an option for exits. I spoke to one VC this morning who called this a good outcome. He said early Series A and Series B investors will see a nice return in this deal, while later round investors who may be underwater, at least they get their money back. It's a good gauge of where we are right now, guys. Getting your money back is sort of the new standard. That's what VCs want.
Yeah, flat is the new up, I guess, Deirdre. So what are the conversations like about others that were waiting in the wings to go public, the IPO pipeline?
Well, if you're not a generative AI company, and those aren't anywhere close to going public, then the tone is sort of wait and see. We're heading into the year end. No one wants to do a roadshow during the holiday season. But I've been hearing maybe wait until the second half of next year when sort of you have a clear view of where interest rates are going to go and maybe the markets could be a little more settled. So you do have companies that are waiting in the wings, but that may need to raise money, right? So you can tap the private markets. But again, for anything other than a generative AI company, it's hard. What Klaviyo showed us, though, this is more of your traditional venture-backed company. It's higher growth, and it hasn't done poorly. I know 20% down from its IPO, sort of its peak after IPOing, but it's still up on its IPO price. So that could be an indication that conditions are still okay for the right company.